and welcome to the Global View on this Monday. Well, let's begin with the data we saw, particularly on Friday, US business activity. Holding steady this month, but employment in the private sector declined for the first time in almost 3.5 years. The flash US Composite PMI Output Index was unchanged at 50.7, remaining in expansionary territory as a modest rise in services sector activity offset a contraction in manufacturing. US Treasury yields rose on Friday on the prospect that the Fed will be less likely to cut rates sooner than previously assumed as the economy remains resilient. The yield on the 10-year note rising to 4.47% and the 2-year at 4.95%. And the US dollar slipped against most major currencies on Friday. The Aussie dollar trading at 65.8 US cents. All right, well, let's head across the straight now. Take a look at what's going on in New Zealand with a global perspective. Brad Gordon joining us from Hobson Wealth. Brad, a very good morning to you. Let's first, how do you open there in New Zealand?
A relatively subdued opening at this stage, though it should pick up shortly as international investors start coming into the market. But look, New Zealand's in the last 2 weeks has just seen such a significant shift in that interest rate outlook, and your previous contributor highlighted that this month alone in November, the 2-year swap rate has fallen from about 5.8% to 5%. It's a really significant fall, given that now with the outlook suggesting that the Reserve Bank of New Zealand could be starting to cut interest rates as soon as around about mid-year 2024.
Yeah, of course, that aligns with what we're seeing in the States too, but clearly because the RBNZ went harder and quicker, certainly compared with what we saw on this side. So what are the expectations then for the meeting this week?
Yeah, we've got the monetary policy statement this week, and I think that will be quite interesting to see where the Reserve Bank inflation outlook sits and when exactly they expect the CPI to get back into their target zone of 1% to 3%. Now, there is a little bit of debate about that. I went to a quarterly economic update at Westpac last week, and most people seem to think it was going to be at least 2025, whereas the Reserve Bank is calling for late 2024. So that's probably key as to when the Reserve Bank can start cutting rates. But we've seen most economic indicators turn here. You've seen unemployment tick up, which is what they needed. You're seeing sort of slack come back into the economy. Transport's down, most of the things down, and we've just also this morning having the new government sworn in and expect significant government cost cutting to come through as well. So all of those contributing suggest 2024 is going to be an interesting year for the Reserve Bank.
Yeah, any expectations of what to expect from the new government? Of course, this has taken a while to form a new government, hasn't it?
Well, it has, but it took 3 weeks to finalise the vote count, which was seemingly ridiculous. But and then only 2 and a bit weeks for coalition negotiations. From my sense of it, they've been very thorough in getting to where they are. I think all 3 parties are quite clear on what they wanted to achieve and what they wanted to get into the agreement. So, I think from a business point of view, it's certainly going to be a business-friendly government. And I think it's going to be an economic-friendly government as well. So, I'm quite excited about what the outlook is with now that government they've got to that agreement.
Brad, on the corporate side, what are you watching at the moment, just in terms of some recent reports from some of the larger companies on your side?
Yeah, okay. So we've had a bit of a mini reporting season here in New Zealand. Most companies have a 31 March balance date, so a half year at 30 September. Probably a key couple of ones to highlight: Oceania Healthcare in the retirement village sector. There's 3 or 4 main players in here: Avida, Somerset Ryman, and Oceania. Oceania reported last week, and look, this particular sector, I think, is a sleeping giant because around about 100,000 new retirement units are going to be needed over the next decade in New Zealand. These guys have all pulled back their build rates because of the economic environment. But Oceania Healthcare highlighted in their result last week that they have got record interest in their apartments. Now they've actually slowed the build rate. So to have record interest and at a time when you've actually slowed your build rate, that's pretty good supply-demand balance in my view.
All right. Serko, also an update there, but this is, of course, in the travel space with its software.
Yeah, so Serko travel software they run Flight Centre's corporate travel business as well as Booking.com the Booking.com or Booking for Business partnership with Booking.com, and as well as building out with some key partnerships in the US. Their half year was fantastic. Came in well ahead of the market expectations at 36.3 million revenue for the half year and getting very close to cash flow break even. What sort of stymied the market a wee bit was guidance being quite conservative, but they made it quite clear on the call that guidance reflected the Christmas period, and they just don't know how the Northern Hemisphere will trade through that period yet. But by all accounts, business travel outlook looks quite strong. There's an article on Barron's over the weekend highlighting that business travel is back. So I think that one continues to be a stock to watch.
Brad, great to get us across what is going on in New Zealand. Thanks so much for joining us from Hobson Wealth.
Right, thank you.
All right, now let's turn to a box trade now. Earlier I caught up with Robis from BCA Research, who took a look at the outlook for central bank policy for a number of banks across the globe, and then took a deep dive into the Australia-Canada 2-year and 10-year yield curve convergence, seeing a strong level of conviction in the trade. Let's have a listen.
The RBA stance is actually still on the stimulative side. And the reason I say that is simply looking at where our policy rates are versus underlying inflation. You have policy rate of 4.35%. You still have underlying measures, trimmed core inflation measures around 5.2, and that's a negative real interest rate. And that contrasts to much of the developed world, where you're seeing rates are above inflation, either because central banks have taken rates that high themselves, or inflation has come back down below where those rates are. So Australia really does stand out, and I think that's why you're seeing sort of the bond market still be fairly resilient. You're not seeing the kind of inversion of the Australian government bond yield curve. You would say saying it's the U.S. Treasury curve or the Canadian bond curve, more consistent with stance of tight monetary policy, where markets believe short-term rates are too high and therefore they have to fall going forward because either growth is going to slow or inflation is going to slow a lot. In fact, looking at the inflation-linked bond market and sort of the CPI swaps in Australia measures of market-based inflation expectations, those continue to rise. You're not seeing that in the U.S. You're not seeing that in other countries as well. So I think the market is telling you the RBA stance is not yet restrictive.
However, there is the possibility, of course, the RBA lifted rates by 25 basis points at its last meeting, with the possibility it could go again, if not next month, then maybe early next year. Is that a possibility you're factoring in at the moment?
Absolutely. I think just that the level of rates is still it's still not high enough. Certainly, when we look at what's happening, I guess some of the resiliency of house prices picking up, always an issue for the RBA, but given the importance of the Australian housing market, but to the overall economy. But I think it's still another hike wouldn't surprise me at all. And it really does. We're at that point now in the global interest rate cycle, writ large, that where rates are peaking. And we think for example, I think the Federal Reserve is done, the European Central Bank is done, probably the Bank of England is done, but there are some banks that stand out on the other side that could still raise rates 1-2 more times. Australia could be it's in that camp. Japan, Bank of Japan is actually just starting their tightening policy. The rest of the world's ending it. So there's a lot of these divergences across countries now. Certainly creates opportunities for bond investors. You look at sort of cross-market interest rate spreads and cross-market trades. Impacts currencies too. You see interest rate differentials moving in a wider fashion. It should be something that should benefit, say, the Australian dollar versus currencies that are more later in their or more clearly at the end of their tightening cycle.
So just in terms of those opportunities then, I see in terms of a trade, you're looking at that relative bond yield curve slope of Australia and Canada. What's attracting you there?
Well, there in Canada, the inflation path it's accelerated much more quickly. Their inflation, underlying inflation, is similar to what the trimmed CPI measure we have in Australia. The trimmed Canadian measure is around 3.6%, but that is a measure that includes things such as mortgage interest costs and property taxes, the things that are not in Australia's similar inflation number, or also inflation numbers in other countries. If you take out that kind of ex-mortgage interest cost, underlying inflation there in Canada is like 1.9%, right in the middle of Bank of Canada's 1 to 3% band. So in terms of inflation reaching its target, kind of on apples for apples comparison to other countries, it looks like they're there. Now the problem is obviously Bank of Canada raising rates, that raises mortgage interest costs and it keeps that inflation number higher. But they're aware of that. Bank of Canada is aware of that. And I think even today we saw commentary from Bank of Canada Governor Macklem saying that they're most likely done with their cycle. Rates are peaking. Growth is slowing there. The housing market, again, very important to Canada, so it is for Australia. And housing demand has really, really come off hard as is the high mortgage rates bite. And there's also a variable rate component to Canadian mortgage market there that makes them more sensitive to higher rates. So I think that Canada's pretty clear, kind of a growth inflation combination there. I suggest the Bank of Canada's done. And as I said earlier, their interest rate curve is inverted. Their 10-year rates are still about 60 basis points below their 2-year rates. So in Australia, the curve is still positively sloped. So we see a convergence of those two curves. And more generally, just saying that Canadian fixed income was more attractive than Australia, and as two economies that have a lot of similarities in the sense of being big exporting nations, big housing market component to the economy. Both have highly indebted consumers, so some level of interest rate sensitivity. It looks like Canada's beyond that point where rates are tight. Again, a 5.25% rate there versus a 3.6% inflation rate, a very positive real rate in contrast to what's happening in Australia. So I think that convergence of rates, a nice way to play that is through a flatter Australian curve and a steeper Canadian curve. But it's another expression of just saying that Australian fixed income looks less attractive than Canadian fixed income.
Rob, overall, what's your model bond portfolio? What's the performance been to date, and what are your projections here?
The portfolio has it has both government bonds and credit to it, and sort of the combination of the two has been sort of hedged enough that it's been slowly making gains for the year, on track for sort of outperformance versus a kind of a custom benchmark we have. It has been a tricky year, I think, because there are more cross-country stories like this to play, rather than taking sort of a big bet on a directional bet on low bond yields in general. That did in the summer we saw the yields go higher, but now they've come back already. Seems a more interesting and winning bets in our model portfolio have been more along the lines of overweighting markets that are clearly at the end of tightening cycles, overweighting German government bonds, French government bonds, underweighting markets that are at the start of cycles, underweighting Japanese government bonds. That's been a huge contributor to the returns, and just kind of keeping an overall cautious stance on corporate bonds in general. You know, it's as we're seeing volatility measures come down, markets seem a little more calm, getting excited about Fed rate cuts next year, perhaps, and that's giving a lift to riskier assets like equities and credit. The reason the Fed is getting done because the U.S. economy is slowing. So there's more likelihood that that's more negative for equity and credit markets. So being more cautious on corporate bond side and looking for relative value opportunities more on the government bond side. And so far that's been a winning strategy this year. Next year will be a little different. Next year you think more, I think, bet on lower bond yields in more countries. And that's certainly a story for 2024.
But I see you actually favouring those sovereigns in those countries, and for instance the UK and also the Eurozone, perhaps where they're likely to tip into recession.
Yes, exactly. And just looking at the data right now, it looks like as of the third quarter numbers, we saw that UK was likely dipped into recession, and certainly big European Eurozone economies like Germany followed suit. And the data is still not suggesting there's a rebound coming. And I think that suggested that the ECB and Bank of England, central banks, had to really push rates well above what they believe to be neutral levels. I mean, that ECB discount rate, their policy rate is 4%. They probably think a neutral is something like between 1% and 2%. We'd agree with that. So they're very restrictive policy. And Bank of England, 5.25%. They put that forecast into their own economic models, and it's been their own forecasts are suggesting a big recession coming in the UK. So it just tells you that level of rates in the Bank of England's own way of thinking is way too high, but they've had to do it because inflation's been so high. So Once inflation is cooling off, and in Europe it's really coming down hard. Headline inflation is back below 3. Wage growth is slowing. Core inflation is slowing. Inflation expectations coming down. The ECB probably one of the first central banks next year to cut rates, perhaps as soon as the second quarter of next year. And interestingly, before the Fed, because usually the ECB tends to follow the Fed, but I think the Fed may wait a little longer for delivering their first cuts next year. I think we see it in Europe.
Rob Robis from BCA Research. All right, that is the global view. Stay with us. The Open, just a minute away.